China's losing control. Congress kicked the can down the road. Fed's about to look like super geniuses in the bond market. Well, it thinks they're all fools. All that and more on today's show. I'm your host, Steven Van Metre, and thanks for joining me today, where we don't just talk about the news, talk about how the news impacts you. And things in China, they're getting worse, and everybody's turned a blind eye. For a while there, everyone was worried about what was going on in China, and then all of a sudden they're like, well, that should be a big concern, because when I show you just how much of this Chinese real estate debt is potentially sitting in one of the investment accounts that you own, well, maybe you'll see that how this situation is only at the beginning of how it's going to get worse. And for that, let's head over to the Wall Street Journal, who says China home sales are falling sharply. Now, remember, we talked about this in a previous show, because when you have a debt-based economy, one thing I want you to really understand is it's a confidence game. There's confidence that people are going to pay their bills and their debts. There's confidence that people are going to continue to borrow and consume. And when you start to lose confidence, and this is why those consumer confidence surveys are so important, because when people lose confidence in the economy or the job market or any part of it, it leads to a slowdown. And when there is a natural shortage of money to pay on the debts, well, bad things start to happen. And we talked about how all this going on in the Chinese real estate market would lead to people not wanting to buy because they're losing confidence. Let's take a look. So here you can see there's a home sales decline in September, which is usually a strong month, and raised concerns about economic growth, as it should, considering real estate is about 30% of China's economy. And here we see home sales in China are seizing up as curbs on lending and worries about developers' financial health. Really? Deter housing buyers, cast a pall over an industry that is central to the Chinese economy. Well, the housing not just central to China's Chinese economy, central to the U.S. and all other economies. In recent days, numerous big developers have reported lower sales figures September, with many showing year-over-year declines of more than 20 or 30%. That is a huge number. And again, that is a stark drop-off for a month that leads up to China's October 1st national holiday. Now, this article has been updated since then. So if sustained, the sharp downturn could have serious economic consequences, because real estate has played an outsized role in China's economy in recent years compared with its importance in many other countries. Chinese families have much of their wealth tied up in homes, kind of like you Americans did going into the great financial crisis, and in investment properties, just like Americans did. Slower sales could spill over into investment, construction, potentially hurting growth, employment, and local government financing. And of course, discounting will disperse sales, could hurt home prices and household wealth. But see, the problem just isn't that the sales are slowing down, it's the contagion effects. And so now we'll head over to Reuters, and where we already know that Evergrande recently missed another payment, so they haven't received $150 million worth of coupon payments that were due Monday. We already know that. And now we're seeing that there's an October 18th or 19th deadline, that's next week, where it will formally declare it in default if they haven't paid up. But it's not just Evergrande. This isn't just an Evergrande story, as the article says here. Mid-sized rival Fantasia has also missed a payment, and Modern Land and Civic Holdings are trying to delay deadlines that would most likely still be classed as a default by the main rating agencies. And so that's what you see as a problem, because according to Refinitiv, there is at least $92.3 billion worth of Chinese property developers bonds coming due next year. Now you might say, well, that's not really a big deal. Well, if you've listened to any of the Sunday night chart shows, we talk about how there's this just crazy demand for junk or high yield debt. Well, let me show you where some of these Chinese bonds are hanging out, because that's the concern, is Chinese developers dominate the world's risky debt. Evergrande update, because here we go, is Chinese property developers are responsible for about half of the world's distressed dollar bonds, a fresh indication of the magnitude and global nature of industry woes. So while you're going to start hearing people come out and say, well, we have no exposure, well, there's people that do have exposure. And half of all those distressed bonds from China. Again, does this sound like the great financial crisis that's kicked off in the United States? It should, and that is the risk here, that this just mushrooms out of control and leads to more or an increase in lack of confidence. And that is a domino effect that just cannot be avoided. Of the $139 billion denominated bonds trading at distressed prices, 46% were issued by companies in China's real estate sector, according to data compiled by Bloomberg. That captured bonds trading at yield premium of at least 10 points above their benchmark rates. And that is a key. Here again, another sign of weakening investor confidence. Demand for Chinese dollar bonds fell in September. Shocking. As China Evergrande Group's liquidity woes weigh on primary markets for offshore debts. So that is the issue, is where is all of this debt? It's out there in high yield bond funds all over the world, and it's sitting there just waiting to explode. And you're starting to see more and more of these Chinese property developers are either skipping payments, trying to delay payments, missing payments. It's not just a one-off issue now. The only question is, how big does this get? And can Beijing stop it in time? And so far, they're showing no signs of that. Well, but now the question becomes is, will there be some negative effects coming out of the U.S.? Well, check this out, because finally, the House has passed the short-term debt cap increase sent into President Biden, which is by and large expected to sign off on this. And I said here, expected to swiftly sign the bill to raise the statutory ceiling by $480 billion, a move designed to allow the Treasury Department to meet the federal government's obligations through December 3rd. Now, some believe that this money will last a little bit longer, maybe even into early January, possibly February. But what does that mean? What is actually going to happen is the Treasury is going to go out and borrow a bunch of money. And that is actually not good for the economy right now. Let's take a look at what happens. And you can see here we've got the Treasury General account, the federal government's checkbook here in blue, and we have the trade weighted dollar. Now, a lot of people, the popular view is the dollar is going to weaken. But one thing I want to point out is that in times where the Treasury balance has gone up, well, the dollar has gone up with it or led it higher. And so here you can see the dollar leading the Treasury's account lower. And now the dollar starting to say, hey, we know this is going to go higher, because what actually happens here is when the Treasury borrows money, they're borrowing dollars out of the global economy and putting T-bills in place in exchange for T-bills. Now, will that necessarily deal with the reverse repo problem? I don't think so, not immediately. And my only reason for that is, again, the lack of confidence in Congress right now, that not many people want to hold T-bills as they did before. Now, once this does get resolved, and at some point this debt ceiling issue will get resolved, I believe at that point you'll see a lot of confidence coming back into the T-bill market, where yields will go down. So what we can predict from this is that financial conditions are likely to further tighten with the dollar going higher. And that's what a stronger dollar generally indicates, is tightening financial conditions. But why all of a sudden are bonds starting to rally? Because when you get the dollar going higher and bonds going higher at the same time, or yields falling, bond prices rising, whichever you prefer, it tells you that deflation's coming. It's telling you there's a pretty big risk-off move. So let's look at what's likely to happen to yields. And then all of a sudden you find out the same story tends to be is that when you see generally borrowing coming out, you see off these low levels here, yields went down. You see here borrowing, it went up and then it came back down. And then you see here briefly went up and then came back down. And then here, a lot of borrowing, and yields went down and stayed low. So the general view is as you tighten financial conditions, yields fall. So that's why you're seeing the dollar and bond prices rally. And even though a lot of people think that it has something to do with inflation, that the bond market's just saying that inflation's peaked, the bond market thought inflation peaked earlier this year. That's not the story. The bond market thinks there's about to be a major policy mistake. But first, I want to show you why the Fed may look like super geniuses. And with that, we have to jump into today's inflation story. The CPI came out, and here we see, you're going to see a lot of headlines that say inflation remained high. You're going to see things that it's like it's going to be sticky, and it's going to continue to go higher. And with that, let's jump in here, and we can see the total change. We see the CPI for all items went up 5.4% year over year. Month over month was still pretty warm at 0.4. Now, over the last 6 months, that's on the low side. But overall, in normal conditions, that's fairly high. How about excluding food and energy? The core CPI was only up 0.2% month over month and static at 4% year over year. So it was unchanged. So where is inflation coming from? Because that's one of the questions you should be asking is, well, let's start with the core, excluding food and energy. You see some minus, a minus, a minus, a minus. So you're seeing inflation start to cool off outside of food and energy. And that would tell you where the core CPI goes is where the broad CPI is going to go. And where are we seeing most of the inflation coming from? Well, we're still seeing it mostly in energy, a little bit at food at home compared to fuel oil and piped gas service, which are pretty high at 3.9 and 2.7% month over month. That's where you're seeing the bulk of these changes. You can see the year over year comps in energy is at 25%. And you can see here at gas pipe service at 20%. Those will fade in time. And I'll show you how the Fed's going to look good at this in a moment. So here you can see CPI hovering. This is where you're getting the view that the bond market thinks it's peaked. No, the bond market already thought it peaked on a year-over-year basis. It knew this was coming. The bond market is going to lead consumer prices. Now, keep in mind, the CPI index is a lagging index. It's one of the most lag indexes the government has. So it's not real time at all. But let's continue, and you can see where when we take out food and energy, that is, or here, actually, it's not for just food and energy. When we take commodities less food and energy and consumer services, you see the consumer services, this is where everyone thinks inflation is, and it's really not. It's more in consumer commodities, as we can see there, and that is going to eventually roll over. And now when we take out food and energy and look at the core CPI, we see this thing shoot higher. And we already know, based on the month-over-month comps, this is going to start to come down fairly quickly. And that's pretty interesting because the other view right now is that shelter inflation, rents are going to skyrocket because home prices. There's this view, and it's a fairly good view, that if home prices go up, then landlords raise the rent. I will also put the other spectrum of what if people can't afford those higher rents? If they're forced to pay it because they have no other choice, nowhere else to go, it will lead to less discretionary spending, less consumption in other parts of the economy, and ultimately will not be a good thing. But there is a view that we're going to soon see rent skyrocket. So how does all this translate into the Fed looking like a super genius? Well, we're going to talk in a moment about their balance sheet taper that's coming up. We got the Fed minutes, but let me show you how the Fed tapering could cool inflation when it's not really going to, but they're going to get lucky. So here, let's take a look at this. Here is the consumer price index year over year from the Fed database. And now you see November was the recent low. And that was from, so here we are in October. We just got the September data. So October, we're going to see a drop of the year over year comps. Then it goes down and then it starts to go up. So if the Fed starts to tighten, we'll look at this in November or December. Well, the year over year comps, because of this vertical move here, is going to bring the overall year over year rate of change down. And if that happens, then the Fed's going to stand back and say, look what we did. We tapered the balance sheet and it brought inflation down. But now you already know that's going to happen anyways. It's just maybe that is part of the reason the Fed is in such a rush to taper their balance sheet, is because they know these year over year comps are going to go down and they want to take credit for it. Because if they come down and they don't taper, well, then I guess it makes Fed look like pretty big fools, which is what the bond market talked about is over the last 2 days. But what about some other pressures that are going to bring prices down? Well, in what could be a big win for the Biden administration, the Los Angeles port is going to operate around the clock to ease cargo log jams. So Biden is going to soon announce commitment from one of the nation's busiest ports to run 24/7 ahead of the holiday season. This is a big deal because if we don't have holiday stuff on the shelves, people aren't going to buy it. And holiday spending is a big deal for this economy. Of course, it's a big deal for whoever's in the White House. Doesn't matter, Republican or Democrat. You want a strong holiday season. Biden administration correctly realizes this is an issue and needs to get those goods off cargo ships into stores, onto shelves, and that will eventually bring prices down as all this cargo gets unloaded, because where is this cargo coming from? Low price producers. How about food? Well, are we going to see food inflation come down? Well, for that, we'll head over to Zero Hedge, where corn, soybean futures dip after WASDE forecast bigger reserves. And there you go. The World Agricultural Supply and Demand Estimates report revealed the U.S. raised estimates for domestic stocks, and that is good news. And so let's see. The view was there were tight supplies, and now we have larger than estimated corn and soybeans, which are putting downward pressure on crop prices and potentially soaring food prices, and that is good news. So you look at now the only remaining issue in the CPI, if food prices start to come down or slow their growth to a more nominal level where they're not creating these big year-over-year comps, it comes down to the energy sector. And well, for that, we'll have to wait until tomorrow, where we get the crude oil reports from the Department of Energy. Let's move on to things that are going to make the Fed look foolish, which is the bond market. And the market sees a 90% chance of a rate hike by September 2022. Long bond screams policy error. And why is that? What does that mean? So the Fed is going to try to front run this year-over-year comps of the CPI going down. Smart move. I can't blame them. I'd probably want to do the same myself. But what if those year-over-year comps go below the Fed's 2% target, and all of a sudden the economy doesn't recover? What is the bond market trying to tell you? Why? You hear all these bonds rally during a balance sheet taper. So the Fed's going to buy less bonds and bond prices go up. Why is that? Why? I want you to think about why that is. And the answer is real simple. The bond market believes the Fed is going to embark on a serious policy mistake, that they're going to pull off of their easy support of the economy at the wrong time, and they're going to be forced to come back and buy more bonds later. So what do investors start to do? Actually, it's not so much retail, but major big money managers. They'll start to accumulate bonds at any price they can down here, because they know the Fed will come back and buy it at a much higher price. And that's what the bond market is trying to tell you right now, because we've got the Fed minutes today from their last meeting. And it says here from Bloomberg, the big question the market is trying to glean is just how consensus is the imminent taper talk and potentially sooner than expected rate hike. Now, don't worry too much about the rate hike happening, but what the now path believed is reductions of asset purchases by $10 billion in the case of treasuries and $5 billion per month in the case of mortgage-backed securities. And somewhere in here, it says the target is going to be potentially late November or December. My hunch is they'll try to punt it into December because they don't want to disrupt the holiday season. We still don't know if the Biden administration is going to renominate Jerome Powell for the chair. We don't know. So my guess is he'll try to punt that just as far as he can. And the bond market saying, no go, you're going to be back-fed in a big way. And here's what the proposed tapering schedule would look like. It would take their purchases down to zero by the mid of next year, assuming they pull that off and do it. And again, as I mentioned, that has been bullish for bond prices in the past because it's been perceived as a policy mistake. This time, unlikely to be any different. But what is the Fed focused on? While they give us all kinds of reasons for the taper, there's one data point they're mostly focused on, and that's the job openings and labor turnover survey, which showed now there's off the record high down to 10.439 million jobs available. Now, if you're wondering why this is one of their favorite data points, is because if you look at who was the former Fed chair, Janet Yellen, this is her favorite. She loved the JOLTS survey. And who is her protege? Who followed her up? Jerome Powell. So of course they're going to be looking at this, because why does this matter to the Fed? It's not that there's just 10.439 million job openings, my friends. It's the fact that there are 2.055 million more job openings than unemployed workers. And so what is the Fed expecting to happen? Is everybody to go back to work. And because there are more jobs than workers, what is the Fed going to expect? That wages are going to finally go up, which is what they've been dying to get. And when higher wages come and you get all this stuff, cargo off these ships, what will that translate to? Consumption, growth, and the holy grail of the Fed's view that we could finally have sustainable inflation, unless, of course, they turn out to be completely wrong, and then they won't get it. But this is what the Fed is expecting. They're expecting everybody to go back to work. But there's only one problem with that is, for some reason, there is a decline, not only just a decline in job posting, but voluntary quits are going up. So people potentially are retiring or walking away from the job market altogether. This is what the Fed should be focused on, is trying to figure out where everybody is actually going. And let's take a quick look at some economic data. The German ZU economic sentiment is heading lower. That is usually, again, we look at sentiment indicators of what consumers are thinking. It usually means lower stock prices, lower treasury yields. What else do we have in the economic data that is worth taking a quick look at? Small business optimism. Now, what's great is small businesses are about as optimistic as they normally are. The problem is they may be optimistic at a point where there's not much optimism, as people are not going back to work, don't have government stimulus to spend. The question is, where are they going to go? And we'll wrap up real quick here with, we had two really strong treasury auctions. We had the 10-year note, the 30-year bond today. Why are we seeing demand for that? Is it because foreign investors aren't worried about inflation? No, it's because of the standing repo facility. Remember, they can now take those longer term notes and bonds, go to the Fed, and get cash now. And the Fed is trying to push everybody out the curve to try to deal with this T-bill shortage. Pretty good timing given the fact what's going on in Congress right now. But what they've done is they've created demand down the curve, and that's really bullish for bond prices. And if interest rates go down, well, guess where inflation's going down with it. Anyways, thanks for being fans. Thanks for supporting the show. We'll be back with you on Friday. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provided as educational information only, is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by a security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre personal capacity. Opinions expressed in this video that do not reflect the view of Outlets Financial Advisors Inc. or Steven Van Metre Financial.